Well, hi everyone, and welcome to this special webinar called Unpopular Value. It's time to zag. I'm Tom Wilson. I'm the Investor Education and Product Specialist at InvestMud. And I also look after the bootcamp, which is one of our education courses. And just from the very start, we provide general product advice only, not any kind of personal financial advice. And this is a very interactive type webinar. And there's the important information there, obviously, on the screen for you. And what we do is we can take questions as we go along. We've got heaps of questions that have been submitted during the registration process. So definitely put them in there. I'll do my best to weave them into Nathan's presentation. But obviously, we're joined by Nathan Bell, who is the head of the portfolio management, head of research at Intelligent Investor. Hi, Nathan. Good to be speaking with you again.
Thanks, Tom.
Well, did you want to get through and start the presentation? Obviously, we're talking about the Intelligent Investor Growth Fund. It's the secondary offer that is being launched, and that closes on the 26th of May, Friday, 5 p.m. So you've got time to get your applications in, but obviously we'll go through what it is, and if you've got questions, definitely ask.
Thanks a lot, Tom, and welcome everyone this morning, and thanks for tuning in. My presentations always look pretty much the same, and we tend to end up going through the same sort of themes, I guess, over the course of the presentation. If it's not in the formal presentation, then in the Q&A. This slide deck, I really want to focus on the performance of the fund. I want to talk about where we've been, where we're going. I want to talk about what the market's been doing and where I think that's going. And so if you've got any questions about actually how the fund works, or particular stocks, or anything that's sort of not related to performance, by all means, please send in your questions, and we'll have plenty of time for Q&A. But I really want my part of the formal presentation to be all about the performance today, which is a little bit unusual. It's not what I tend to focus on, but I just think it's really important where we are at the moment, and given some of the moves in the portfolio and a lot of the stocks at the moment, more recently. So I'm just going to skip through these first few slides, but for anyone that's new and not particularly familiar with us or hasn't sat in on one of these webinars before, there's just a couple of slides about our process and what we're looking for. The skin in the game, I just include this in every presentation. I just wish there would be some updated slides, because the numbers, as wide as the dispersion is between the performance of founder-led companies and the rest, it would be even much more pronounced, given these charts only go up to 2014. But there just hasn't been an update. There's been plenty of research that comes up and continues to confirm this, but there's no actual nice chart. All the articles I looked again last night, and they all just use these same charts, so it'd be nice to see them updated at some point. But it really just goes to what we're looking for. And if you have a look at what have been the best stocks for our fund over time, and just our almost 25-year journey at Intelligent Investor, it's not always, but very often it's the companies with the founders in charge. So this is the first slide about the performance. For people who are looking at the website and they may only see the performance for the fund since it's been listed, this is actually since we've been officially managing other people's money, which goes back to 2015. So it's got more years included, and much more representative of what we're capable of, because at least you've gone through a cycle in sort of 1920, which was the COVID bear market. So you've seen how we've performed through tough times, and you've seen how we've performed in good times, and now we're somewhere in the middle. And the end result is that we're a couple of percent annualized ahead of the index, and I consider that a pass. As long as we're 1% ahead, then obviously it's worth investing in the fund, because you're doing better than the index after fees. And we all know that just a small premium over the index multiplied over 10, 20, 30 years is a huge amount of money. So as long as we're ahead of the index, that's the main thing. But personally, I'm always aiming for 2 to 4%. And the reason for that is because we're not a huge fund. We're not managing billions of dollars, so we're not weighed down by having to buy just the biggest stocks. There is a limit to how many small stocks we can buy, but it really is, if we do that part of the investing well, that can make a huge difference to our portfolio over time. So the fact we can own, it's not really many, it's only probably 4 or 5 really good small cap stocks that can compound your money at high rates for a long time, that can make a huge difference to our fund over time. And the thing I like most about our fund is that we can actually hang on to those small caps as they become large caps and much more familiar names. If you're running a small cap fund, for example, you may find this brilliant stock that you know inside out. You've invested for years, it's gone up, manyfold since you bought it, and then it reaches, say, $1 billion, and you've got to sell it to keep telling people you're a small cap, which just makes no sense whatsoever, and it would certainly make no sense if you're an individual. You wouldn't sell CSL after it had gone up 2 or 3 times just because it reached a certain market value. So that really should be the driver of the best after-tax returns as well, because you're not turning over the portfolio. So if you went and did this measurement back in January, that gap would have been closer to 4%, or the outperformance would have been closer to 4%, and that's actually what I'm aiming for. I think that's what we're capable of for some of the reasons I just mentioned, but also just the experience on the team, and we've been doing this for a long time now, and again, we've got those advantages of not being a huge fund and a bit of flexibility with the small caps. And I think if you do your job right over time, and again, the fund's not $1 billion or more, then 3 to 4% is quite achievable. But obviously, it depends on where you are in the market cycle. And at the moment, I feel like our portfolio values many of the stocks are very depressed, which was why I think there's at least 10 stocks in the portfolio that could potentially double, and there's probably 2 or 3, if not more, that over the next decade could actually go up many times their current value. So that's what we're really looking for. And I'm not going to talk about all the different names that make up those 10 today, but if you've got any questions about specific stocks, by all means, send them in. But if you had a look at the performance in January, it would have been, I think we were about 3.7% ahead per year. And depending on, you basically had a choice last year. And I thought our performance through the end of the bull market and then capitalizing on those huge share prices, huge valuations with the takeovers for the fund, and then buying the coal stocks, which did really, really well for us, and hanging on to a lot of that cash from the takeovers, worked absolutely brilliantly, way better than I could have ever hoped for last year. And so we were one of the very few funds that actually did really, really well through that period. And then what you've had since February is that, or early this year at least, the market's been very strong, and the contrarians like us, who were very few, who did well the year before, they've trailed while everyone else has done well just by owning the biggest stocks in the market. And I'm going to talk about that specifically in a moment. But so our performance has shrunk from 3.7 to 2.1. And because the fund hasn't been around that long, it doesn't actually take much change in the short-term numbers to knock those since inception numbers around. Obviously, if the fund had been around for 15 or 20 years, then that outperformance would have only shrunk to 3% or something like that. So that might actually feel like a bad thing, but actually I think it's a really good thing, because it still means we've got a big opportunity when the portfolio has its next big run, that we can really put some big runs on the board. And then if we can do that for 4 or 5 years, then it really means that those, since inception, our performance numbers won't be as volatile and be, I think, much more consistent, and therefore more indicative of what we can actually achieve over time. The funny thing is, and depending on what side of the coin you're on, whether you were the contrarian last year and did well with coal and cash, or whether you were just a regular investor and bought the big stocks, or just owned the market and you've done well in this 6 months, essentially everyone's ended up in the same period after the last 12 months. Obviously, there's some better and worse performances here and there, but if I just have a look at some of these dot points, this describes our recent performance. I just want to talk about what's not working at the moment, why I'm not worried about it, what changes we've made in the portfolio, and just really that bottom one's probably the most important one. If you forget all the detail about what I talk about today or any of the Q&A, just really remember that bottom line there. I really think this is the right time to be contrarian and the right time to be an active manager. We've just had this enormous period, which I really thought had come to an end probably 18 months ago, where the ETFs and big index funds had ruled the world because you just had to own the market, and the market had done fantastically. And then we had this period where it was a little bit rocky, and I really thought that the massive premiums that people were paying for those big stocks at that time was over, and what we've seen is actually a reversal of that. So we're sort of back to where we were a couple of years ago, where I think people are afraid and they find safety in the biggest, most familiar names. And now you've actually got a bunch of those big names that are barely offering potential returns greater than the you can get in fixed income. So, yes, you might have some tax benefits from the franking credits or something like that, but those small premiums to me are very hard to justify investing in the stock market, given how much riskier it is than fixed income. But just in terms of specifically with the fund, what hasn't worked this year, at least anyway, has been our small caps. small caps across the board have been absolutely hammered, and that's really where the most value is in the market. As I said, we're limited in how many small cap stocks we can own because of the ASX liquidity rules. Just on that, sometimes people see the fund and not many units traded on a daily basis and think that the actual fund is illiquid. It couldn't be further from the truth. That just represents the demand for units in the fund, but it's a highly liquid portfolio. We actually have ex-ASX senior people on the board at InvestSmart, and believe me, they're always asking about liquidity of the funds. So it's actually very tight. I could take you through the liquidity rules, but it's not just about a maximum limit on how many you can own, but they also get you on how many shares you own of the stock. So there's sort of, they get you from every angle. So we really need to do our best with that small cap bucket because it's not very big. So we have to be very selective.
There's always a lot of questions around the liquidity, even from our side, where looking at questions here, people saying, why are you doing this again? Like, why are you having another offer? Does it dilute the fund? And what we actually have is a liquidity provider. And when you go and look at it on, say, CommSec or NabTrade or a trading platform, you'll usually see on the bid and ask, so the buy and sell side, 100,000 units of each on each side. So if someone comes in and wants to buy a big chunk, the actual liquidity provider will make those ETF units for us. And if someone comes in and sells a big chunk, basically they'll take them apart and deconstruct them. So there's never any problems in terms of the liquidity of buying and selling, which is one of the benefits of ETFs. But
people do ask sometimes who are new to us and say, why do you do this every year? Why do you have an offer? And there's a few different reasons. One, I would be doing these annual updates anyway, so it's fairly easy for us to attach the offer to it. Yes, all you save is brokerage, and yes, you can just go and buy units right now in the market if you want to. You don't have to participate through this method. But there are other people who just like to, they don't want to invest until they get a kick in the pants and get an update, and they just want to get the stories on track. Others who don't have online brokers and prefer to use this method. So. And the important one for our business is we need to grow. We're not making enough money yet off our businesses, and you can look at InvestSmart, and we want a bigger, healthier business where we can pay everybody well and we can make the investments we want to make, and we want to add analysts to the team, for example. And we've been through a period where most of our life we've been budget constrained, and we're still there, and so we need to grow our business. And this is what I feel is the right way to do it, because obviously nobody's forcing anyone to invest in the fund, but what we hope what we're doing is providing great returns, and our existing clients are happy and they want to invest more as time goes on, and hopefully those people tell some other people and they come on the webinar and then they're comfortable with the story and they invest, and that's how we grow our business. Alternatives are pretty tough, and it means you have to go and meet with financial planners, and then all of a sudden there's risks of having one or two big investors in the fund, and things like that. There's sort of all these other things, and I just really like the way we have our business set up. We don't have any performance fees on the business on this fund. I've talked about it before. It's something I would like because I think we need to be rewarding people better for performance in the business. But again, we can't make those sort of calls at the moment because the business just isn't big enough. So we need to grow our funds, and the only way we're going to grow our funds is by delivering for our clients. And this is an opportunity to explain, where the performance is and what we expect. And obviously, if we don't deliver over time, then no one's going to invest in the fund. So I feel this is a really honest, transparent way to grow our business, and I just describe the reasons we need to. So that's why we come out with the secondary offers. By all means, I don't want you to be forced to invest in the fund, and I certainly don't want people who aren't long-term investors in the fund, because it's just not worth it. I don't want anyone to see great returns we've had in recent years and then invest, and then all of a sudden the fund goes down a bit because you go through a bit of a tough time, either with the fund specifically or the market, and then they get angsty and then they start sending in questions and then they get abusive and then they pull their money out. Like, what benefit is that to us or to anyone else? So we've got one of the best client bases I can ever imagine. They're very supportive, and they understand what long-term investing is about, and they understand we go through good times and bad times, and there's no way you can outperform over time if you don't go through bad times, unless you're Bernie Madoff. So that's what I really like about these annual webinars, and it's great that you're on here too, Tom, because we get all the questions from people and it gives us a chance to talk to them and actually answer them face to face.
Yeah, absolutely.
Particularly after COVID, where we actually couldn't see anybody.
Well, that's the other thing is too is, we do have a very strong client base, but a lot of us here at InvestSmart, Intelligent Investor, Eureka Report, we also believe in these funds and we're invested in them as well. And that's one of the questions that we get asked quite often.
No one wants to invest in a fund and then all of a sudden, realise that there's real issues with keeping talent, in the background, or the business is insolvent. I'm not saying InvestSmart is, but just trying to make the point that there's no point investing in a fund that doesn't have financial wherewithal behind it and great people and lots of talent to grow the business for the next 10 or 20 years. If you're thinking about investing in a fund for the next 10 or 20 years, which is how you should be thinking about it, what's the point of investing in a fund if there's problems in the management teams, or and you're losing great talent along the way? So these are all business issues that investors shouldn't have to worry about, and they don't have to worry about with InvestSmart. But that just describes why we need to grow our business, and why I think this is the best way to do it, and certainly the most enjoyable way to do it for me anyway. So getting back to the performance, so we talked about a few of the, if I was a young person today and I was starting out and I was looking for where the real value is, I'd be spending all my days on small caps at the moment, and the mid caps. There's really some stocks that are way down. In that second bullet point there, I've talked about Credit Corp, Pinnacle, MA Financial, RPM Global, and Frontier are just, some of them are like 60, 70, Frontier even probably 75 or 80% down now from the highs. And the question you ask yourself with these businesses is, has something gone wrong, or are these the businesses that we want to own for the next 10 or 20 years because they're going to produce higher earnings and add a lot of value to the fund as they become more valuable businesses over the next 10 or 20 years? And those stocks certainly fit the bill. So in a sense, I always talk about trying to create, when you go through these, I guess, tougher periods or whatever, you can't call it a bear market. It's not a bear market in Australia, but this downturn or whatever it is, trying to create a portfolio that's like a coiled spring, so that when you come out of this period and you go back into better times, into the next bull market, and maybe we're already in it, you really want the earnings to grow quickly, and then the multiples of these businesses to go back up. And that's how you create the coiled spring, and that's how you smash the market on the way up. So I think we did far better than I could have ever imagined, protecting people's money out of the bull market up until a couple of years ago, and then the coal stocks did wonderful for us. And it's just amazing to me. I've been doing a lot of reflections. I'll talk about that in a moment. And just how hard you have to work to find, Whitehaven Coal that ended up going up, 11-fold for some of our purchases, even though we sold them a bit under that. And how hard you have to work to keep finding these ideas, and yet, you're only 2% ahead of the index. It just seems like so much work and so much stress for just a small advantage. But that 2%, if you can do that over 10 or 20 years, I mean, the difference in dollars is just enormous. But I don't think people understand just how hard it is. And I used to think being a great stock picker was really how you produce the best returns, and I don't even think that's it anymore. I think the longer I go on with this career, it's more just having the grit and determination just to get through these tough periods and hang in there while you're getting abused and everyone telling you you're an idiot, and you're watching stocks go down that you really like, and you look at other stocks go up and you just can't believe your eyes. And you've just really got to soldier through these periods, and it's more about your grit and sort of your mental state and ability to keep persevering that makes all the difference, rather than necessarily picking the greatest stocks.
But I was going to say, Nathan, even since we've been doing these webinars, has there ever been a time though where that sort of doesn't happen? Like if the market is doing well, you can get criticized for, oh, well, I'm not going to get into this fund because the market's at its peak, so I'm not going to do anything. And then when it's, had some volatility, it's too volatile, I'm not going to do anything. When it's trending sideways, it's, well, I'm not going to do anything. I know we talk about this a lot in the bootcamp course, where people have that hesitation, that fear, and they miss out because of it.
You're spot on. And one of the quotes I've been thinking about lately is, in a bull market, who needs stock analysts? And in a bear market, who needs stocks? And it's just like, you basically, as a professional fund manager, you can't win. You've either got people frightened when the bargains are the best, and when times are going good, it's just very hard to get them out of an existing fund or an existing investment. But what I do know is that our process, it's going to be 25 years next year since Intelligent Investor started, which is amazing. And I think I started 7 years in, so aside from the 3 years I had out of the business, it's been 17 years since I started, and a lot has changed, and I'm going to talk about some of those reflections in the next slide. But I just want to talk quickly about just some of the changes in the portfolio lately. There haven't been any huge changes, but I'll just point you to the penultimate bullet point there. It says a Warren Buffett quote, and he says, "Beware the investment activity that produces applause. The great moves are usually greeted by yawns." And that really describes the changes we made to the portfolio recently. Sold out of Omni Bridgeway. It was a management change there, and if there's been a trigger for selling, in my experience, has been a change of CEO. The Lottery Corp just became quite expensive and did better for us than I expected, and we've reduced our energy exposure over the last year. And so we capitalised a bit on our coal stocks, but I think, I definitely got too focused on trying to deliver best after-tax returns for investors in the funds, including our income fund with the coal stocks, and getting as much out of those stocks through dividends rather than capital gains. And I think that was a mistake. I probably could have added, I'm not really sure, maybe 1 or 2%, not a huge amount, but I think we could have sold those coal stocks at the peaks. But there's too much argument around getting the dividends, and sometimes you just got to take the value when it's there, and I think that was a mistake. So that's probably cost us a couple of percent at least. We don't really own much of Whitehaven anymore, but we still had a big chunk of New Hope, which paid a nice 40-cent distribution, which is about 8%. I think it's fully franked dividend yield on on an investment that I still think it's got some capital gains left in it. But that was only 1/2 the year dividend, so that wasn't even an annual dividend. So we're going to get lots of good dividends out of New Hope anyway. But our energy exposure overall, if you include Woodside, which is different to the coal stocks, because the coal stocks, we really thought, and it is happening, but not quite to the degree we hoped with Whitehaven as far as dividends are concerned, but all their profits are coming back to us as cash. They have actually announced some investments, but Woodside's actually got some big investments to make. So it does have a big dividend yield, but it's also got to keep reinvesting a lot of that cash too. So in that sense, those profits from dividends from Woodside are not as valuable as what they have been for the coal stocks, and potentially we're going into recession. So I don't think Woodside's all that cheap anymore, given the share price has doubled from the lows.
I just wanted to weave in some questions here. There's one from James, and there's also one from Eloise. Basically, James is just sort of asking, what proportion of the fund is still invested in these coal stocks? And I think, like you've sort of already said, like over the long term, they must be doing poorly, or they must do poorly in the long term. And what about the future energy? Do you see any opportunities for like hydrogen, wind? Will we focus on any others?
Yeah, so I sort of answered most of that first one. We've kept New Hope though, because I still think it's cheap, and when you're getting potentially 15% fully franked dividends, you don't need to own it for very long to get all your money back. So, but the overall exposure is much reduced from what it was. In terms of the new energy stocks, it's really hard to find companies just every day that are consistently profitable and going to be bigger, more valuable businesses in the future, and that the market hasn't recognised, so you can pay a cheap price. And everybody's pretty high on green energy at the moment, and looking through the businesses, all I see at the moment is a lot of investment and very little return. Now, there may emerge some big winners, but often these high investment periods produce a lot of competitors. And then, as we saw with the solar companies a few years back, or maybe it was 5 or 6 years back, they basically almost all went broke. And I think there was 1 or 2 left that are still profitable, and they were the ones you wanted to own. But it's really hard to know how much money they're going to make over time. So it's a really complicated space, and it's just in the too hard bucket. At the moment, I'm certainly open-minded to it, because it'd be brilliant if we could find 2 or 3 green energy stars and get them in our ethical portfolio as well. And maybe if they can become really profitable and pay dividends and a bit more like infrastructure stocks, that'd be awesome. But I just don't know what those names are yet, and I think it's too early to tell. In terms of the stocks we've added, they're really just rudimentary names this year. There's been just some stunning results. This pinpoint ResMed's recent result was phenomenal. Obviously, it's not going to keep growing revenue and earnings at 30% rates, because Philips Respironics has had some issues, and they'll get back online eventually. But it was a stunning result, and it's a great business, and I really want over the next couple of years, I'd just love to have a core, more of a core, which I think we've had in the past, of these sort of ResMeds and CSLs and just REA groups and whatever. They've just been too expensive for a while. But CSL's one, I think, is actually finally, after the share price has gone nowhere for 3.5 years, is finally starting to look more interesting. Could be the case that in 12 months you may own this stock on a forecast price to earnings ratio of 25 or less, which is obviously not in the bargain basement, but I think for a stock of the quality of CSL, is arguably the best business on the market. I think that's quite reasonable. Loviso had a stunning result. That's probably the one regret I've had personally over the last 12 months, when we sold it, I think, about $25 when the bull market was flying, and was pretty happy with that when it dropped back down to $13. And when it got there, that should have been the time when we built the stake up again, and we didn't, because there was just a lot going on and we had other stocks. And we finally just started re-adding it recently, because the growth story is definitely intact there, and had a great result, and it would have been even better if the new CEO wasn't getting paid so much. Mineral resources is one. I've actually got, for people who want to download the slide deck later, which we always make available, there's half a dozen slides later in the deck that actually talk about a bunch of the stocks in the portfolio and why we own them and what we like about them. So I won't go into detail here. But they're all the changes, and they really are the sort of stocks that are greeted by yawns. And just in case anyone's thinking, oh, this year's starting to look more like the index, really, the portfolio has very little in common with the index. I'd say CSL and Wesfarmers are almost about it. And CSL, I think, is about 7% of the index at the moment. And at some point, valuation allowing, I'd really like to just essentially hedge out that position and have the 6 or 7% in CSL. And then there's sort of no difference between how the index performs and how we performed in vis-a-vis arguably the greatest business on the index in the market. So I look at our portfolio, and then I look back at the index, and I'll talk about this in a minute, but I just see there's huge potential in our fund, and I see almost no potential in the market, because everyone's herding into the biggest stocks now that they didn't offer high returns in the first place. And even Gora has been talking to me about selling BHP, which has been a cornerstone stock in our income portfolio, partly for the dividends. So it shows you how expensive he thinks the iron ore miners are at this point, and they're 20% of the index. Throw in the banks, which look pretty expensive as well, and the A-REITs, which we don't really have any interest in, and there's like 70% of the market. So can we do 2% a year better than those stocks for the next 10, 20 years? And I absolutely think so, and that's why I'm really aiming for the 3 to 4%, which depending on if we get a big broad buying opportunity at some point, makes it a lot easier. But otherwise, I'm not changing my personal aim of over 3%. If you're in an elite company, if you can get there and maintain that over a long period of time, so that's really what I aim for personally. I just thought I'd quickly share a few reflections on the last 17 years, because some of these apply more to sort of a long time ago rather than more recently, but some of them still apply now. And as good as our returns have been, I think they could have been higher, and they could have been much easier if we just done a few things better. And I think over time, certainly earlier, we were far too focused on esoteric ideas. That was really the culture of Intelligent Investor. You sort of got the pats on the back for finding the obscure, and that just doesn't tend to work the best. And the reason is, and usually those esoteric ideas are some sort of statistically cheap stock. But the problem with those stocks is, one, it's very stressful owning them, because the longer you own them, the more likely something is to go wrong with them, because they're lower quality businesses. Two, you have to sell them when they reach fair value, because they're not compounders and not going to grow quick enough over time to justify holding on to them. And that's not tax effective. So it's a really tough way to invest. A big one too is we've identified all these great winning stocks, and I even go back to the early days, and CSL and Nanosonics, for example, which were just a couple of my recommendations in the newsletter, and they just haven't had a big impact on the funds. And obviously the funds haven't been around for anywhere. I mean, some of those recommendations were well before the fund started, but we just haven't got the benefit. And I think we do a really, really good job. Not always. I think sort of, I guess sort of, the 3 years I was out of the business was when the tech stocks really boomed. And the last article, one of the last articles I wrote in the newsletter was about Altium. I said I need to come back to this, and then I left, and the stock was $2.50 at the time. And we ended up adding the stock back as a buy when James came back to the business, and I think by then the stock was like $30 or something. You know, even Afterpay, we recognised early while I was away, but I believe they were in whatever the former version of Afterpay was, and then they sold out after a double or something like that. You know, I think it's maybe it went from like $1 to $2 or $1 to $3 or something like that, and it ended up going to 160. And like I could tell you all these stories, and I could even tell you about all the stocks that I recommended to members that I never bought myself, and I just look back and kick myself. And so we've still got these good returns, and yet I just feel like we've made it so difficult than it needed to be, and we do a really good job usually of identifying the big winners early on, and we need to keep doing that, and I think get back to that as a team. But once you identify those stocks, you really just got to let them run, and I think we've been too focused on, you know, trying to pinpoint the value of these stocks and say we're value investors and turn them over and find the next thing. And the best thing looking back is when you find the absolute brilliant companies like the REA groups or the CSLs, you can't replace them. So you don't want to turn them over, and like they tend to surprise you on the upside over time. And we really haven't, and it's really hard to do because you can't put this stuff in a spreadsheet and you can't predict what acquisitions CSL is going to make, or you know, maybe some international growth that REA Group's going to get or anything like that. You just have to believe you're in the right business and they have the right people running them, and they're going to create the value. And so when they get a bit expensive, you just got to ignore it and just hang on to them. And I think that's probably the biggest mistake we've made over time. We've made that for a very long time, and I'm trying to get better at that as well. It's easier said than done, but I think if just these 2 or 3 things, if we can do these better over time, then that's why I believe we can outperform by 3 to 4%. Feeling happy about just sort of getting a B plus or an A minus with 2% above the index, as good as that is, and most fund managers will give their right leg for that. But to me, we've got too many advantages and too much experience, and I just think we're better than that. So we need to be aiming high. You know, whether we get there or not, time will tell. But you know, it was only a few months ago that we were there, and a few of our small caps have been hammered, along with every other most other small cap stocks in the market. So it's not really an issue with the business, and I fully expect them to snap back at some point. And the other one is, I think more recently, I think we've been too quick to dismiss, particularly the emerging tech stocks, you know, the WiseTechs and the Zeros, too quick to dismiss them. And you would have noticed for those followed the newsletter, when I came back, you know, we did a lot of work on getting across the WiseTechs and the Zeros and all these companies that hadn't been covered. And I think the other thing is we've been too slow to change our mind. And I mean that 2 ways. I mean, one, when we're wrong. So Star Entertainment was one where once the ex-treasurer of the New South Wales government came out, Matt Keane, and said, even though we've just basically reneged on a tax deal, long-term tax deal that was signed only 18 months ago, you know, we should have sold out then, because that really gave the excuse for the new CEO at Star to raise far more money at a much bigger discount than we expected. And of course, so we needed to move quicker on that. But also, I think when we've dismissed a business before for some reason, and then all of a sudden it's come clear that it's actually a great business, we need to be quick to dismiss the past and recognise what we've got now. And we are doing a better job of it, but it's still got a way to go. So they're the 3 or 4 things that, you know, maybe not of much interest to people in the fund, or people just want us to do the job for them. But in terms of my job and what the team are working on, I just think this is where we can really increase the returns in future very easily, you know, actually by making our lives easier rather than making it more difficult. So at the moment, I've probably taken up a little too much time with the slides, so I'll just quickly run through this. But we've got a really narrow market at the moment, and it's easy to look back at the last 6 months of the returns from our funds and go, geez, they're awful, you know, what are you doing wrong? And really, the main returns from the big indexes in Australia and in the US, and I've just got US numbers here because it's easier, that just really narrow. If you look under the hood from the sort of top 10 stocks here as I've used in the US example, which have produced 86% of the S&P 500's 8.2% gain this year. If you take them away, you know, the market's not making any money or has been losing money. And the Russell 2000 index, which is a much broader index than the S&P 500, that's fallen 12% since February, and that's much more in line with what we've experienced, and that's because our portfolio mirrors, you know, an index more like the Russell 2000, where you've got more small caps and more mid caps, which is where the growth's going to come from in the future. And you know, I've talked about the Pinnacles and MA Financials and these companies, which I think are going to drive our returns in the future. and they've just been knocked down because their earnings are a bit cyclical, and no one wants small caps at the moment. Everybody wants certainty, so they're falling into the iron ore miners, they're buying the banks, they're buying A-REITs. Nobody wants to be involved in the next profit downgrade. So anything that they're worried about is just getting hammered at the moment, but particularly that small cap area. And that's where we actually think the best bargains are, but we really can't buy anymore because we've already got decent sized positions and we're limited by those ASX liquidity rules. So unfortunately, it's an area we can't take any more advantage of. So I'll quickly just run through, I think this is the last main slide I want to talk about, but there's at least 10 stocks in the fund that I think can double or more, 3 or 4 that could go up many times over the next decade. So we won't be selling them, even though they're causing us a little bit of pain at the moment. Excuse me. I actually had a laugh at this one. This next point I've included for a little while. So what performs in increasing interest rate environments? Well, virtually says everything. The only thing not on the list is just don't buy stocks that go down. So depending on who you ask, you'll get one of these answers. But the one thing that we know works over time is just paying sensible prices for great businesses. So that's where we're focused, and that's why we've been tiptoeing into some of the best businesses in the market that we haven't known for a little while, and just have had extraordinary results lately. And that really ties into that idea I've just talked about not being biased by your old opinions. When you see the facts change and you just see how fast these businesses are growing, you can afford to pay big premiums or higher than average premiums for them, and they're some of them are cheaper than what they have been for a little while. And now the earnings are really starting to catch up to those high valuations after pretty stunted share price performances over recent years. Obviously, I'm talking my own book here, but I think we're really going to be in a sweet spot over the next 5 to 10 years with active management. It's up to us to deliver, obviously, but if I just look at those big areas of the market, I'm even seeing analysts at big financial institutions have target prices for companies like BHP that are 10% share price, yet they still haven't put a sell on them. So they're normally the most bullish pool in the market, and even they're saying that the values for some of these are worth less than what they're currently trading at. So, and I may not talk about this more, but I just find it absolutely stunning that except for CBA, and its returns haven't been that good over this period either, but the other 3 major banks, their share prices are within a whisker of 2002. Can you imagine people buying those stocks in 2002 and then thinking that we're going to have this epic, maybe once in a lifetime credit and mortgage housing boom, and yet their share prices are almost the same as where they were 21 years ago? I find that staggering. I just think that's quite incredible, and so we really want to avoid those sort of stocks. It's all well and good to get your 3 or 4% dividend yield, but that's not enough reward to investing in the market. So this is a time when I really feel like you're going to get rewarded for zigging and just zagging away from the market, where everybody just wants certainty and no one wants to sit on the next profit downgrade. Again, I'm not expecting a GFC scenario, and no one really is, but obviously you can't count that out. But it's still the case that higher interest rates are still feeding through, and we've seen bankruptcies in the US have been increasing recently. We've seen banks go bust on both sides of the Atlantic, and we've seen the UK pension fund basically collapse before the government got involved. So far, every time the system's broke, the government central banks have got in and fixed it up, and it actually makes a bit of a joke about quantitative tightening in the US, which is highly undone by the quantitative easing following the 2 bank bankruptcies in America. So normally you don't really need to understand how it works, but with quantitative tightening, it's a bit like extra interest rate increases. So that has been happening. So in a sense, worried about higher interest rates, but actually the amount of government spending still going on, and with quantitative tightening turning back to quantitative easing, is actually somewhat of a still stimulatory environment. So it's just worth keeping that in mind. And I think the biggest mistake at the moment, I've actually put in there locking in mediocre returns, because I think that's we could just go and buy a portfolio of the best stocks on the market right now, but I think you'd be lucky to get 10% returns. It'd be more like 7 or 8% would be my guess. And I think it's too early to wave the white flag and think that we're not going to get any more great opportunities over the next year or so, because I think we only need 2 or 3, and all the cash will be gone anyway. So we can be a bit flexible, but I'm not necessarily sure the biggest mistake is actually locking in mediocre returns now. When I think about it, I think is being too confident and making too big a calls in any one stock. I think that would be the biggest mistake, because Even people like Stanley Druckenmiller, who's possibly the greatest trader or investor who's ever lived, even he's saying this is the most difficult market environment he's ever seen. And the reason is because you've still got very high valuations, and you've also got quite high interest rates. And there's just no easy options. You've got to decide what sort of investor you want to be. Do you want to stick to quality and moderate your return expectations, or do you want to go into small caps and accept more risk, but potentially earn double digits, or just invest in bonds or fixed income and just wait till maybe the market gets cheaper at some point, or there becomes something more obvious to do. So, in terms of all those things, I think just being concentrated or fixated on one idea or one stock or one sort of big opportunity, I think would be the big mistake at the moment, because it's far more difficult and complex than that. Sorry, I did have one more slide, and I do apologise for talking so long, so it means we're going to have to constrict the questions a little bit. But dividends is not what this portfolio is about. This fund is really about finding companies that can reinvest their profits over time and grow earnings for hopefully for decades, and compound your money at high after-tax rate returns. That's what we're really chasing. But interestingly, at the moment, the dividends for a bunch of the stocks in the portfolio haven't recovered since COVID still. So there's actually some decent dividends coming out of the fund at the moment, and I think they'll increase over time. And obviously, we expect they're going to grow over time. And I talk about this with our income webinars. But if you can find the growing businesses, even if you have to sacrifice 1 or 2% on the dividend you initially, like over the years, you will and truly pass those other stocks in total returns, and you have really healthy growing dividends. And so it's not a specific aim of this fund, but it's definitely a result of the investment process. And so I think the dividends actually should be quite nice in this fund over the next few years, but we'll see. Just wanted to reiterate the liquidity one, because I just know some people don't really understand the fund, and they think it's a listed investment company, and they don't really understand how a actively managed listed ETF works. But again, I'll just highlight that liquidity. Don't look at the amount of units trading. The liquidity in the portfolio is in the stocks, and we own very highly liquid, very large stocks, along with a handful of the small ones. So, and as I've said repeatedly, that there's a limit to how many small caps we can own. So these are very liquid funds, and they're designed to be highly liquid, and I've got no choice no matter how many small caps I'd like to own at the moment.
Yeah, there's some really good points on there too. And even from my side of the business, we get asked about some of these regular things, and management fee is 0.97% per annum. So that's the fee if you hold the Intelligent Investor Australian Equity Growth Fund. There's a few questions here. I know you have slides on specific stocks, and as an investor in the growth fund as well, I know it does hold some of the FDV, and you wrote a report on the 7th of May, so only 11 days ago, where you went through why it's had a bit of a drop. Obviously, it was doing that capital raising, and it did it at a 20% discount, which is disappointing. But you were saying that the next 18 months or so is going to be make or break for Frontier Digital. Is that still the case? Is that something that we still think? I know it's only a small position, but do you have any more comments on FDV?
Yeah, I don't really have anything to add. I think the risks are well known. This isn't a situation where something from left field is going to come and knock you over. Like the risks have been well known from the beginning, and I've been banging on about them for, I think, 5 years now. I only wish I'd wrote the stock up as an ideas lab rather than an actual idea, and so I could just manage it in the fund, because it's been one of the biggest performers in the fund, despite the fact the share's down just about 75 or 80% now from the highs. I think we made about 8%, we locked in about 8% profits on the way up in this stock. So it's been a big performer for the fund. And again, it just shows you why I'm much happier having a stock like this in the fund, where I can manage the position rather than in the newsletter, where you can't save people from themselves, as we saw with the Magellan recommendation, where people very foolishly put over 20% of their wealth into this stock, even though the maximum portfolio limit was 5%. So that's why we're a bit reluctant we won't really be recommending spec buys, I don't think, in the future. In the newsletter, they'll just be ideas labs. But as far as like the potential is all still there. Things are obviously deteriorating in Pakistan, but Pakistan business has no influence on the cash flows of the business. It's just like a shareholding dividends. It's just raised money, so it's got cash on the balance sheet, so it's not going broke anytime soon. If you're trying to pick a stock that people just would not want to own in this environment. You know, it's a frontier market stock, so it's just getting whacked. I haven't seen I'm waiting on the transcript from the annual meeting 2 days ago, but obviously there was some bad news there because it sent the price down another 10%. So there was something that people didn't like there. Hopefully it'll be up on Capital IQ today. I can read and find out what it was, but I can't imagine it's going to be anything I'm not already aware of. The fact is it's just going to be tough over the next couple of years, but at the moment at least, the Latin American business, which is where the value is breaking even. And this is, the one thing I'd say about Frontier is the CEO and founder, Sean Di Gregorio, he hasn't actually failed yet in terms of the businesses. The only thing that's wrecked the investment case is the Pakistan currency. As the means worked out exactly as we could have hoped. And if you had told me when I bought this stock personally in the IPO at 50 cents in 2015, that in 7 years, the Pakistan business would work out exactly how we wanted it to, and it's the market leader. And then it would have this Latin American business where they were aiming for $100 million of revenue in the next few years. I would have went, oh, brilliant. You know, the stock price would be at $2, $2.50. And here we are, all because of the Pakistan exchange rate and now the fears over the balance sheet and a really poorly timed capital raising for such a tiny amount of money to pay these earnouts has just demolished the share price. And you know, I don't know where it ends up. Maybe things get worse. And I think I told people a while ago that I had a dream about a year ago that it went to 10 cents before I bought a whole heap of shares and I became rich. So the first part of that seems to be happening, but you know, everybody knows everything about this stock. There's nothing to not know about it. So you either want to own it and back Sean in and back the business in for the next 5 or 10 years, or you don't. But I haven't increased the stake in the fund materially. I really want to leave one more swing in case this ends up being an RHG situation, which long-term investors or members of the subscription business might remember back from 2009, where the stock got to 5 cents and ended up being worth $2.50 in fully franked dividends. So maybe that's the future for Frontier.
And we're getting a few comments coming in.
I should say.
We're getting a few comments coming in saying, please don't remove the spec buys. So hopefully, I know you might do some more.
Yeah, we go through this every cycle. I tell you, it's just to my head in. You get you get all these complaints about the stocks not making any money, and our record in speculative buys is appalling. It's absolutely appalling. And our record, just to give you an idea of what I was talking about before, but when I did the research for the ethical fund many years ago, I pulled out all 450 buy recommendations from the newsletter that we'd had over all the journey. And remembering a lot of these were repeat recommendations, so they're not unique recommendations necessarily, but you know, you might have re-recommended, I don't know, ARB 5 times or something. But the average annualized return from those quality names that passed the ethical filter was, I think it was 14.7% annualized, and the return from the things that didn't pass the filter was 10.1. So we have an absolutely awful, like the returns, I wouldn't actually be surprised if we've got negative returns from our spec buyers now. They're that bad. And I get that people want to have fun, but we can do that through Ideas Labs. We don't need to be putting people into these just crappy situations, and there's just been too many lately. And I think this is a time just to focus on quality, and if we find something interesting, we can do it in Ideas Labs, where the only people that should really be buying those sort of things are people that can do their own homework anyway. So we won't stop the ideas, but I think the way we present them needs to change.
That's a really good point. I know we've covered off the Ideas Lab previously, but if you're a subscriber to Intelligent Investor, you can also take up a free trial as well. There's actually an area where, you know, for some reason they're not covered, whether they're perhaps too small or they skate under the other criteria, but you still publish some commentary on them. So definitely check it out. I like to look at that myself on a weekly basis or so. There's some good questions here.
Sorry, Tom, I just want to jump. If I say one thing, I think one thing that would really be much better for everybody with the spec buyers is if the spec buyers was something like a WiseTech or a Xero early in their life, where you think you've really got something, but you're not really sure, and they're not fully profitable yet, and they're still building, and you've got some concerns. Like, they're the ones, you know, the things that can actually return 30, 40, 50 times your money, you know, they're the things that should be spec buyers, not some of these sort of crappy things where even if they do well, you're not going to make that much money anyway. So that, to me, is the major change that we need to make, is identifying those what are going to be great businesses earlier. And if we're unsure about them, make them the spec buyers rather than just, we know these are really low quality, we know they're going to be tough, and end up just thinking the price is compensating for the risk. And because in the end, you go through a downturn and it turns out they're just rubbish stocks.
The other thing here is too, with you know, some of those small caps that you're saying that you can't sort of fit into the fund because of the liquidity rules, the ASX ones. You still, you know, provide recommendations on the website though, don't you, for those? So if someone wanted to perhaps hold them outside of the growth fund, they could still do that?
Yeah, absolutely. So part of the rule, and again, this is a headache for me at times with the funds, but we have to write up every single stock that's in the funds, has to be written up in the newsletter first. So, you know, it doesn't mean necessarily everything is exactly the same. Like there's oftentimes, like even the recent purchases, I've been buying a lot of stocks that are holds, for example, you know, the great quality stuff that it's hard to go out there and say they're an outright buy, but they're just wonderful businesses that we think are going to compound well over time. So it's not like we can only buy just the buy recommendations for the funds or anything, but everything has to be written up first. So it does slow me down, and sometimes there are things I'd like to do in the funds that we just can't. But if you know, it's transparent, and I still think we can outperform anyway, and we've already shown we can, so it doesn't constrain us too much. But it is part of the transparent nature of our business, where we don't want to be seen to be front running stocks in the funds, and then in the newsletter. I think it's just a bad look, but you know, we're not allowed to do it anyway.
Yep. There's still a lot of questions coming in about thoughts on, I guess, oil, gas companies, you know, what their potential is, given that I know you went through a lot of the green energy don't seem to present any good opportunities at the moment. Copper stocks, people asking about banks. I know you've covered off some slides, but is there any kind of general type commentary you could provide on those?
Yeah, up to you, Tom. I don't know if we can, but I'm happy to run 5 or 10 minutes over if we need to get through the questions. But the banks, I just don't have any interest in. I just don't think there's any growth there. And if the fact that their share prices have gone nowhere in since 2002 isn't telling you what you need to know about the banks, then I don't know what is. And certainly with a growth fund, it's just they're not growth stocks. They haven't been growth stocks for well, for 17 years, as it turns out. Sorry, 21 years, as it turns out. So they're not going to feature in the fund unless they get maybe get into a really bad downturn and the bad debts skyrocket, and if there's a real panic and they get to a crazy cheap price. But whenever we get into those situations, they're just other business we prefer to buy anyway. I think the challenge you have, and I think about this often, is if we actually do get a big broad buying opportunity at some point, do you buy the cheaper stuff that's going to provide the big upfront returns, but then you have to sell them because they reach fair value and they're not necessarily the best businesses? Or do you give up a little bit of the short-term return and buy the best businesses to have, you know, the higher returns over the longer term and less turnover in the portfolio, which gives you a much better after-tax outcome? And I'm sure the answer is it'll be a mix as always, but I'm really leaning more towards the quality because it just makes the investing much easier and much more profitable for clients when you get longer into the tooth into those bull markets. In terms of oil and gas, the oil and gas industry in Australia is actually really small, at least as far as the stock market's concerned. You know, people are seeing Warren Buffett buying Occidental in America, and you know, some value investors buying a lot of stock in these oil companies in the US. But the thing is, they are actually real oil companies in the sense that they're absolute giants and they're just milking their assets for cash at the moment. So the dividend yields are really huge and they're not making necessarily huge investments, and that supports a higher oil price over time. And it's also great for the cash flow of the business, because in the past they used to just take every dollar they earned and then they have to plow it back into producing in the next field or developing the next field or finding the next field, all those sort of things. And it's just not doing that. So they've become these cash flow machines. And if you look in the past, I think at some point, I may have the numbers wrong, but at some point the constitution of the energy companies in the S&P 500 was something like maybe 15 or 20%, or maybe even more. And at the moment, I think it's only like 2.5%. So if you're a contrarian who likes those dogs of the Dow type theories, and you look at the tech stocks at the moment, which are, I don't know, I think about a quarter of the index, These things don't tend to last over decades. They sort of swell up where one area is of real interest, and then that shrinks, and then another area, which might be energy this time, and maybe it's technology that goes backwards, and maybe the energy stocks become 10 or 15%. I'm not sure, but I think the tech stocks are here to stay no matter what. So they really are the giants of the index at the moment, and I think they're a bit more, they're a lot more stable than what the past tech stocks have been, for example. But the other difficulty for the Australian oil and gas investors is our companies aren't like those oil companies. They're not just spitting off cash. They've actually got big investments to make. So that's why we don't have a very big position in Woodside anymore, and our coal stocks are smaller, even though we think we're going to get a lot of cash out of them still. And I just don't think they're very cheap. When Woodside got to, I think, to get like to $17, yeah, you can make it's cheap at that price. But at 32 or 33, I'm just, you can buy much better quality companies, I think, for a similar level of valuation.
Yeah, and I mean, we've covered off a lot of questions. There's still a few that are remaining, but there's some that I guess we've sort of looked at during the webinar. I'll just touch base quickly on some of the details about the offer and even how to contact us if you've got any questions. I'm not sure if there's a slide you've got there, Nathan, that has the contact details on the last page, but the other thing is too, look at that, perfect. I'll get together this webinar. So if you've going to show it to someone else or you wanted to watch it again, I'll edit it and get it uploaded to our website. But we'll also email everyone that attended or couldn't attend and let them know that it's there to watch. And the slide deck will be published as well. So those stocks that Nathan referred to will have a bit more detail. The offer, remember, I've just put it into the chat here, but I'll also put the website up. It's theintelligentinvestor.com.au/IIGF-offer. But I'll put that up so you can see that. And we went through the reasons why you might perhaps go through this offer as opposed to buying it off the ASX through a broker at the moment. The offer closes on the Friday, the 26th of May at 5 p.m. So we give you BPay details when you apply, and you have to get that money to us before that 5 p.m. cutoff. Sometimes you might need to do it as early as possible because some banks might not let you send large amounts. The minimum investment amount for this is $2,000. And if you've got a HIN, a holder identification number already, so if you've got a share trading account, for example, with CommSec, NabTrade, etc., definitely put that HIN into the application, and that way your units will get allotted directly to your share trading account, which will save you heaps of time. But yeah, Nathan's got the information there. So if you come across more information that you require or any questions, you can email info@intelligentinvestor.com.au. The phone number there is as well. I've also put up the help center because a lot of the questions that we get asked are actually available in the help center. The other thing is we've got a live chat on the website, so you can speak to one of us and get an answer or even links sent to you as well. But what I'll do is after this, I'll go through and let Nathan know some of the other questions that we've got and find a way to try and cover them off. But was there anything else you wanted to cover off today, Nathan?
No, thanks for your help as always, Tom. Just want to thank everybody for tuning in. Thank everybody for their support. Want everyone to pray for some cheaper prices. And I know most people don't want to see the value of the fund going down or any of their shares going down, but personally, I just really love a big, broad opportunity to set the fund up for the next 10 years with very little input from us and just get the businesses right. And for anyone that's newer and not familiar with Intelligent Investor or our fund, this is a sort of fund where you should feel very comfortable owning. I've talked about the small caps and probably gives a sense that it's a risky fund, but it's anything but. I'm not sure what we're exactly allowed to say in terms of risks. But this is a portfolio with some of the best companies on the market, and we're trying to find the next group of wonderful businesses. And as far as the type of portfolio it is, obviously all stock funds are risky, and you need to consider your own risk tolerances. And we can't provide personal advice or anything like that. But in terms of a business that I can sleep well with, because I think people are worried about what the near future's got in store for us, but we want cheaper prices. We want that big opportunity. I'd love to sell some of the more expensive stocks that have done well for us in the fund and reload the portfolio with much cheaper things we can own for the next decade and produce even higher returns. But the the price for higher returns in the future is that you need the market to pull back in the short term. So I'm living for that moment. I'm not sure whether we're going to get it, but regardless, you know, my expectations for the outperformance of the fund over time haven't changed, and I think we hold all the cards, and it's really up to us to deliver. You know, if we're here in 5 years' time and the outperformance isn't above 2%, then I don't think we don't have anyone to blame but ourselves, and that's a really nice position to be in because not many fund managers can say that.
Excellent. Well, that's lovely. And thanks to everyone for attending, and we'll get this up to the website. But thanks, Nathan, as per usual, and we'll talk again next time.
Thanks, Tom.